Okay, let's wrap this up. I hope you are doing well. Mr. Mesh here. In this session, we are going to look at private infrastructure risk and return in the context of strategic asset allocation. So let's get right into this. So this is going to be brief. Infrastructure risk and return. We look at infrastructure investments in the context of their unique role and their uniqueness. Remember, the services that are provided by infrastructure investments are inelastic in demand, which means they're not sensitive to price changes and they're less exposed to market cyclicality and economic shocks. So this actually makes them attractive investments, because if the demand of a product is inelastic, it's not sensitive to demand, it's not sensitive to price. If the price continues to go up, people will still buy that product. The cash flows, they are stable over long-term contractual periods. For instance, if you put a toll road, those toll fees, you're going to receive them for a long time, and those cash flows are pretty much stable because people are always going to be traveling. Benefit from significant barriers to entry. So there are significant barriers to entry because infrastructure investments are capital intensive, so which makes them attractive for long-term investments. They have lower risk compared to other private market assets, but they also have stable cash flow and long-term investment horizons. They are seen as a long-term liability matching alternative to default risk-free government bonds due to favorable duration characteristics. Because they are long-term, they can be considered for long-term liability matching. If you have liabilities that you have to pay in the future, you can invest in infrastructure knowing that in the long term, the capital is going to come and it will be somehow guaranteed by these stable cash flows. And then you match your liabilities by investing in infrastructure investments. The Infra 300 equity index of unlisted infrastructure investments had a return of around 12% per annum between 2009 and 2019, with 13.9% volatility and 24% correlation with MSCI World Index. And this index represents about 23 countries, large to mid-cap private equity investments. You see there's a relatively low correlation here between this Infra 300 equity index and the MSCI World Index. Okay, so this generally moves with global equity movements. Investor type, long-term institutional investors. So people with money are the ones that invest in infrastructure. It's capital intensive. So you have institutional investors like your pensions, sovereign wealth fund, family offices, and these, it will align also with their risk tolerance. They can take up a lot of risk, and they also have longer time horizons as compared to other smaller investors. Despite complexity and illiquidity, infrastructure investments provide a diversified, stable cash flow and can match anticipated liability cash flows in the long run. So we said they can be used as liability matching alternatives. Because of the low correlation with public equity, so there's a low correlation with public equity, it therefore implies that they can be diversified with public equity. So you can put them in a portfolio with public equity, and it provides a diversification benefit. Let's look at an exercise to wrap this up. Read through all of this and then attempt these two questions. Let's look at the first one. So you can pause the video, read through and pause, and then we do the questions together. The first one, we want to evaluate a possible equity investment by Northern States into the Tayback Airport opportunity with respect to the pension fund's performance target and allocation range for infrastructure investments. So we need to look at the targets, the ranges for infrastructure investments. Okay, we see the plan has a performance target of exceeding a return of US CPI plus 5%, okay, per annum, net fees on its private unlisted investments, and seeks to exceed the appropriate public market benchmark for publicly traded infrastructure. So they can invest in private assets to achieve CPI plus 5%. We saw that the internal rate of return of investing in this project, the Taybek Airport, was going to give an internal rate of return of 13.5%. And this is actually greater than the return target here. This is actually greater than the return target. So they can invest in the infrastructure investments. They have long-term target allocations for the core investments 30 to 70, 20 to 60% for value add, and opportunistic 5 to 10. So they can invest in infrastructure. This is the private infrastructure, right? And Northern States currently has a 70% allocation in US-based core infrastructure via a closed-end fund and 30% value add. So they have 70% in infrastructure and 30% in value add infrastructure. And this is via a core investment which is allowed by their policy. Okay. This actually means that Northern States can invest up to 25% based on the target. They can invest up to 25% in opportunistic investments. And remember, these opportunistic investments are likely what the Taybek, the TBA airport project is. This is because it's a new project, so it would likely fall under opportunistic investments. Hence, increasing their portfolio by investing in this airport would provide the return which they require. Okay. Also, they have this long-term target of investing in the United States and OECD and so forth. Okay. And here they say with the 70% and 30% value add funds on assets in EU, all of which are member countries of OECD, all of them, they're member countries of OECD, they could also diversify by geography. They could also diversify by geography, by geographic location. And they'll do that by investing up to 25% in non-OECD countries. That would also provide a diversification potential. All right, so this is just a high-level explanation of how you'd approach that question. Evaluate a possible equity investment by Northern States into Taybek Airport opportunity with respect to the pension fund strategic objectives for infrastructure investments. Okay, so we want to see a possible equity investment by Northern States, right? We look at the strategic objectives. These are the strategic objectives which we are given: to improve investment portfolio diversification, to earn a yield above earnings assumptions and generate stable cash flows, to match future liabilities and expected long-term distributions, to preserve capital and hedge against inflation, to engage as a responsible investor, to promote sound environmental practices. Okay, so an investment into TBA is going to likely provide diversification by geography. So this diversification is going to come in terms of geodiversification. There's going to be geodiversification, and they also want to earn yield above the earnings assumption. This project has a projected internal rate of return of 13.5%. So we would actually meet this objective and this objective by investing in TBA, in the TBA investment, because we will likely exceed the return objectives, and also we are going to diversify according to geography. Okay. And we see, but we did a sensitivity analysis, right? And there are things like inflation which might come into effect, and there are things like cost overruns, with things like cost overruns, with things like project delays. And all of these things are likely to have an impact on reducing the internal rate of return for the project. So these future spikes in inflation and all of these other challenges that might be met could be challenged by, could actually dampen their ability to meet their debt obligations. So it might have that challenge of the liability matching strategy should things go wrong in terms of inflation overruns and delays. It's a positive. So they should consider this when making the decision. Okay, and also they want to promote they want to promote sound environmental practices, which means that during this construction process, they would want to make sure that certain environmental guidelines are adhered to. Okay, and in construction, sometimes there are disturbances to the ecosystem. Anyway, I think this pretty much does it. It's a high level explanation as always. You can just gather your thoughts and analyze based on what is given in the case study. I hope you guys understand this. And this brings us to the end of this topic on private infrastructure investments. We are going to do no more questions. Okay, not now. In the next session, we'll look at a lot of practice exercises to wrap this up. But for now, Mr. Mash is done. Enjoy private infrastructure investments. I'll see you in the next one. Cheers.